Hey guys, it is Patrick, and before you dive into this lesson, I wanted you to know that you're about to start a new section of Principles of Accounting, and you can actually head to my website at www.patrickleemsa.com, where you can actually purchase and then download and then print the worksheets that go along with this lesson and all of the lessons that are connected to this section of Principles of Accounting. It's a great way to take notes so that you can actually concentrate on what I'm teaching you in our lessons, and then you can able to write notes along with the notes that I am showing on your screen. So all you have to do is head to my website at www.patrickleemsa.com. There you can purchase them and then download them, and then you can use them on this and all of the lessons that are connected to this section. So go ahead and do that. And if you are ready, let's head into our first lesson in this section right now. All right, welcome to section 3. In this section, we're going to be looking at the income statement. We're going to help you understand what goes on the income statement. And then specifically, we're going to show you the journal entries related to an income statement and those accounts, specifically revenues and expenses, and what those journal entries would look like at the end of the day. Now, in this lesson, we're going to give you an introduction of the income statement. You kind of have already gotten a brief understanding of the income statement in the first section, but this is our chance to dive down a little bit deeper on this income statement. So, the income statement represents a company's revenues and expenses at any given time. So notice here's our expanded equation. We're specifically looking at the revenues and expenses. Now the key word here is that it is for a given period of time. So when we look at the income statement, we're looking for a time. We're not looking for revenues for a particular day, although we can generate those statements. We're actually looking at these statements from a period of, what was our revenues and expenses over a year, 6 months, a month, because we want to see a cycle go through. And if we just do a day, we're not necessarily having all of the expenses associated with a month, especially if we don't pay them. We pay them once a month, okay? So we're looking at a cycle or a period of time. Now, the income statement summarizes the financial results of a organization over that period of time. Revenues are the increases in assets or the reductions of liabilities due to providing goods or services to the customer. So when we think about revenues, this is like the technical definition, but revenues are the increases in assets, so increases in, let's say, cash, or the reduction of liabilities. So maybe we've already gotten the cash, but we are reducing what we owe to a customer because they prepaid us. So an increase in asset or reduction in liabilities due to providing goods or services to the customer. And that's the key there. We're not just receiving cash as a donation per se. We're not receiving cash because we sold stock, because that's not providing a good or service to the customer. Our stockholders are not customers. They are shareholders, okay? Expenses, what are those? Expenses are decreases in assets or increases in liabilities due to providing goods or services to the customer. So it's kind of the same definitions as before. Expenses are those things that we spend in order to generate the revenues in a company has. So decreases in assets. So if we're paying cash, that's a decrease in asset. And why are we paying cash? We're paying cash because we're providing a good or service to the customer. Increases in liabilities. Maybe we're incurring the expense, but we haven't paid for it. So we are seeing an increase in the liabilities because we have incurred that expense, but we haven't necessarily paid for it. Now, the basic income statement equation, we talked about this in section 1, bringing it back full circle here. We have revenues minus expenses gives us net income, and that's what the income statement is all about. Taking our revenues, subtracting our expenses to get to our net income or net loss. If you see brackets over a number, that means net loss. That means a negative number. So if you see 500 with brackets, that means we lost $500 in this equation. So just knowing that. Now, there's one assumption that you should know when it comes to the income statement, it's the time period assumption. Now, the time period assumption assumes that an entity can break their accounting into segments of time to report results for a period in time. What does that mean? That means that, we can take a look at a company's financial information, and we can break it into like a year, and then we can report on that year on the income statement. So when we look at an income statement for 1 year, we can actually break it. We can actually put dividers in the accounting of an organization based on years. And so when we do that, we have all of the expenses and all the revenues that the company has incurred during the year in that income statement. So the time period assumption tells us that it is assumed that we can divide a company's financials into different time periods as necessary to be able to show a proper income statement. Okay, so that's what the time period assumption is. The income statement adheres to the time period assumption by segmenting a company's revenues and expenses over time, at least annually. So when we think about, like, say, a hard asset, and we'll talk about this in the depreciation section, the cost is allocated over time. And so if we buy a car for $10,000 and it's going to last us 10 years, we don't have a $10,000 expense on day one, because we're going to use that car for 10 years. So what we do is we spread that $10,000 over 10 years, and it's really costing us $1,000 a year to operate that car, because it initially costs us $10,000. We're going to spread that cost over 10 years, and we get about $1,000 a year. It's wrong to say that it costs us $10,000 today and then zero the rest, because we're still getting value. We're still using the value that car has. So thinking about that, we can break those expenses, we can break those incomes into the actual periods in which they occur. Now, here's an example of Facebook's consolidated statement of income. You've kind of seen it before. I know it's tiny print here, but if you notice here, we've got the who, the what, and we don't have the when, but that's because it was in an annual report and the dates on the annual report. Notice we have the revenues. Now, we've got some complicated things here, because usually it's just revenues and expenses, but I want you to show you a real life income statement. So we got revenues, we have some expenses here, and then we have some other income and revenue. So that's where it kind of gets mixed up, but we usually start with revenues and then we subtract expenses to get to our net income here at the bottom. Now, this is for 3 years, 2016, 2017, and 2018. That's why there's 3 columns. And then below that are kind of complicated things that we may talk about at the very end of this course. So you don't really need to know what they are right now, this specific moment, but that's additional information that we're going to give to shareholders so they, again, have the necessary information to make decisions regarding the company. That's our job in financial accounting. So revenues minus expenses. So for Facebook, they had revenues of $55.8 billion with a B dollars. They had, depending on where you are, expenses of about $30.9 billion. And then their total net income after some adjustments is $22.1 billion with a B dollars. If you told me 10 years ago that they would be there, I'd probably laugh at you, but there it is. They grew $7 billion in net income from 2017 to 2018. We're still waiting for 2019, so we don't know that exactly, but that is definitely huge. So that is an introduction to the income statement. Again, some of this stuff you already knew because we covered that in section 1, but that gives you a baseline foundation of that income statement. In the next couple of lessons, we're going to help you understand some more accounting knowledge and accounting theory and topics, and then we'll get to some journal entries associated with the income statement. So I hope you enjoyed this lesson, and we'll see you in the next video. Hey guys, it's Patrick. Before you skip ahead to the next section, just wanted to come on here and tell you to not forget to like this video and maybe share this video with someone that you know that would get a lot out of this lesson. Maybe a classmate that you know. This would be a great way to introduce them to this channel. So share this video with them, maybe your mom or your dad, someone, so that they know that you're really learning accounting topics here on YouTube and you're not just playing cat videos over and over again. Now, if you want to help us grow this channel, what would be great is if you press the subscribe button and maybe even turn on the notification bell if you want to get alerted the next time we upload a video to this channel. And put in the comment section below, what did you eat last night? It would be so weird for people to come and look at the comments, but what did you eat last night? I might throw in a comment after you if you put that in the comment section below. So do that now. What did you eat last night? All right, so enough of the fun stuff. Hope you enjoyed this lesson, and we'll see you in the next video.